Good morning, ladies and gentlemen. Welcome to Dhanush channel. In this video, I am going to continue the economic survey 2025 of Indian economy that was released by Ministry of Finance on January 31st, 2025. So I have already made 4 videos as far as this point is considered. So what I will be doing is I will be continuing that lecture in these videos. So if you go for a quick recap on what are the topics that we have discussed so far. In my first topic, I have discussed about the preface of economic survey, where I have given who prepares this economic survey and what are the intricacies of it. After that, in the first chapter, we started discussing about what are the various global uncertainties and how India is poised to grow in this financial year and in the upcoming financial year, along with the so-called macroeconomic fundamentals of this country. Subsequently, I have also discussed into the second chapter, that is monetary and financial management. That was my last class, where I have given a quick recap about the entire second chapter. So as a part of that second chapter, today I am going to financial intermediaries, where I will be going in depth and I will be discussing about various concepts on what economic survey has said about our financial intermediaries. And we all know that financial intermediaries are classified into 3 or 4. First one is the banks, insurance sector, pension sector, and then you have capital market segment and the so-called money market segment. So as far as banks are considered, this year economic survey, as usual, like every year, has given more data on this. So what is more important is they have focused on two to three new elements in this banking sector. So in this point of discussion, what I am going to do is I am going to discuss about all those components, about how economic survey has discussed on all these components as far as the Indian banking sector is considered. So let's start with financial intermediation. So we all know that financial intermediaries play a very, very crucial role in credit dispersal and in the inclusive growth. One of the primary things for inclusive growth to attain, according to Professor K.C. Chakravarty, the former Deputy Governor of RBI, is to attain inclusive growth. And in order to attain inclusive growth, financial inclusion is extremely important apart from the so-called other parameters of inclusive growth. That is what they have said. And here banks are playing a very, very crucial role. So in this chapter of economic survey, they have discussed about the following aspects as far as the financial inclusion is considered. They have started at how the financial intermediaries, that is banks, have performed in the country in the last 1 year. Second one is they have discussed about rural penetration of the banking sector and how rural credit is being dispersed by various banks. The third component that they discussed is about developmental financial institutions. In the year 2023, Government of India has come out with National Bank for Infrastructure and Rural Development, National Bank for Infrastructure Development, a developmental financial institution. So survey has focused on that, where we can expect some questions in that segment. The fourth thing that they have discussed is what is the role of artificial intelligence in the so-called banking sector. So this is the fourth component that they have discussed. And the fifth one is what are the challenges that the banking sector is going to face in the upcoming days. And the sixth one that they discuss is how far the so-called the recovery procedures have helped in recovering of our loans that the banks are indebted or the banks have to collect from various depositors. So these are the 6 elements that they have discussed very extensively in almost 40 paragraphs of second chapter. So I'm going to give a quick summary before going and taking you to that part of economic survey and making you to go through a quick glance of that paragraphs. So to start with, how Indian banks have performed in the last 1 year. So the economic survey starts with optimism, and there was a great saying in economic survey saying that the scheduled commercial banks of the country has been performing successfully in the country. The asset qualities of all the banks in India have substantially increased. Thereby, the gross non-performing assets of the banks have come to 12-year low. It was in the year 2018 that the gross NPAs have become very, very high. Today, it has reduced to 2.6% of total loans. There has been increase in provisional amount that the banks have maintained according to the Basel norms. As a result, the net NPAs also have declined to 12-year low to 0.6% of total loans. So this is first thing about gross NPAs and net NPAs and provisioning amount. The second thing that economic survey highlights is the common equity tier 1 capital that is asked by the RBI to be maintained by all the banks according to the Basel norms is 8%. Almost all the banks in India has achieved CET1 targets. This is the next thing that we have to focus. Subsequently, the capital to risk-weighted capital assets of all the banks, CRAR, is somewhere around 16% growth, and that was quite substantial growth that we have seen. As a result, there has been much cushion for the Indian banks to withstand the challenges that may arise due to non-performing assets. After discussing the CRAR, the next thing that they say is the profit of banks. So thanks to the increasing credit that it has been giving, and due to the differential interest rates between the so-called the lending rate and the deposit rate, the gross profits of all the banks have substantially increased. However, when it comes to the net profits, there has been a slight decrease in the net profits of the banks due to the so-called the convergence between the growth of the credit cycle as well as the so-called the growth of the deposit cycle. So this is another thing. So the NPAs of the banks have performed well. Common equity tier 1 capital was achieved. CRAR targets was achieved. And then the provisioning amount was increased. Quality of the assets have increased. Profits of the banks have been substantially improved. So overall, if you look at the banking sector at present in India, be it the private sector banks or scheduled commercial public sector banks, both the banks are doing decently well. That is one observation that we make from economic survey. Subsequently, the survey speaks about how far the credit has been dispersed by the banks in India. They go with sectoral wise. To the agricultural sector and to the industrial sector, there has been substantial increase in the growth of credit that the banks have given. So this has pointed out that almost 75% of the rural areas have come under the so-called formal credit, thereby pushing them out of the clutches of money lenders. And when you look at the growth in the credit to the agriculture as far as banks is considered, somewhere around 3.5% to 3.8% growth rate was observed. And when it comes to the industrial sector, the growth rate was somewhere around 6%. In this industrial sector, the majority part of the credit has been dispersed to the micro, small, medium enterprises. And we know both agriculture and MSMEs are a part of priority sector lending of RBI. Hence, the rural credit has substantially increased according to the latest budget. This is another observation as far as credit growth is considered. And the credit growth was very decent. Now, the third thing that RBI economic survey does is, they have compared what was the growth rate in the country and what was the credit growth in the country. So they started comparing both, and they have analyzed that the credit to growth in the country is on par with the so-called GDP growth in the country. Right. As a result, there has been some synchronization between the growth of GDP and this one in terms of the total credit that the banks have given to non-financial sector, private sector, non-financial investments. India stands at 8th position in the total credit that private people have got from the banks. Top country is China. Right, this is the thing as far as the credit cycle is considered. So overall, if you look at the statistical analysis of banks in India, all the banks in India has performed decently well. This is the first analysis that we can observe from this year economic survey. Subsequently, if you go for something like financial institutions, going to each and every financial institution, this year economic survey has substantially focused on rural credit or rural financial distribution. As a part of it, rural financial intermediation includes many banks such as regional rural banks, rural cooperative banks. You have differential banks, micro financial institutions are lending in the rural areas. All these are supervised by National Bank for Agriculture and Rural Development, NABARD, and the final regulator ultimately was RBI. So what our economic survey points out is, RRBs have played a very significant role in making the rural credit to be reached to the so-called the most vulnerable sections of the villages. As a result, today majority of the rural community has come into the banking sector, and thanks to the government initiatives like Pradhan Mantri Jan Dhan Yojana, which was started under this government, that is Prime Minister, Honorable Prime Minister Shri Narendra Modi has started that venture of Pradhan Mantri Jan Dhan Yojana, and that was quite successful. Because of this, there has been increase in the formal financial institutions in the banking sector, particularly in the rural areas. And as a part of it, it speaks about RRBs. So RRBs were established in the year 1975 according to RRB Act by Srimati Indira Gandhi to make sure that the banks are going to the rural areas and they are serving the unserved areas and underserved areas of the country. Initially, it was started with 5 banks. By the year 2006, the total number of RRBs in the country was 133. And after that, as there are different number of RRBs, the government of India has started consolidating these RRBs. And today, as of 2023, we had 43 RRBs functioning in 696 districts of the country. So in almost all the regions, RRBs were established and they are serving the rural areas of the country. And they have almost 3.5 crore accounts and they have been disbursing account to these people. So there has been substantial base of rural population in this regional rural banks. And when it comes to the performance of the regional rural banks, Government of India has did recapitalization of RRBs. As a result, the financial sector of the RRBs substantially improved thanks to recapitalization. Somewhere around 10,000 crores were announced for RRBs, and almost all the banks in RRBs have sufficient amount of capital today, and the non-performing assets even in RRBs have come down. So this is some progress as far as RRBs are considered, and rural credit is in a very good shape. Hence, in the upcoming days, this is going to act as one of the foundational pillars for making India to go into Viksit Bharat. Coming to the developmental financial institutions, the survey has exclusively focused on one new developmental financial institution known as National Bank for Infrastructure and Infrastructure Development. Now we know this, in the year 2023, the Parliament of India has passed this act and they have created this developmental financial institution. By the way, what are developmental financial institutions? Developmental financial institutions are those institutions which will be established particularly to develop a particular sector. Take for example, all India financial intermediaries like NABARD that will be looking at the development of agriculture and rural development, go for SIDB, small industries development, go for Exim Bank, export imports of India. So all these are playing a very crucial role in the development of a particular sectors, be it MSMEs, be it small industries, or be it the so-called agricultural sector. In the similar lines, to boost the infrastructure that is required, the economy that is, or money that is required to boost infrastructure, Government of India has come out with this venture that is called National Bank for Infrastructure Development, and this was classified as the 5th All India Financial Intermediary by RBI. What are the other 4? NABARD, SIDB, Exim Bank and National Housing Bank. Adding this, we have National Bank for Infrastructure Development. These are the 5 All India Financial Intermediaries present today as far as the country is considered, and this is important for prelims. They have also shed light on the other developmental financial institutions like Indian Infrastructure Financial Company Limited, IIFCL, which was established, and they have spoken about how they have developed infrastructure facilities in the country. That was about developmental financial institutions, another important concept of this year economic survey. Moving further, the economic survey has focused on how the banks have come to the healthy sector, particularly through the lens of insolvency and bankruptcy code. The economic survey has clearly stated that the insolvency and bankruptcy code has worked successfully, though there were some challenges, by the way. Since its inception in the year 2016, the insolvency and bankruptcy code has solved almost 1068 cases, recovering somewhere around 3.4 lakh crores of amount. So major part of money has been recovered by IBC, and as a result, IBC was quite successful. Due to this, the corporates who are taking the loans have come into a systematic streamline, and they have started increasing the amount that they have to keep aside to cover the risks against non-performing assets. So again, this is a financial or this is a very good system as far as IBC code is considered. Hence, this year budget, if you economic survey, if you look at in detail, the economic survey is very, very clear that we have achieved this progress substantially as far as IBC code is considered. Then to catch the emerging technologies of artificial intelligence in the banking sector, economic survey has pointed out that the next stage of revolution is going to happen in artificial intelligence. Hence, even the banks in India has to capture the emerging technologies and they have to induce this artificial intelligence into their streamline whenever they are discussing about these components. That is another thing that they started discussing as far as AI is considered. And in this economic survey has said that all the banks have introduced ATMs by the way around 1960s and 1970s. Slowly as we entered into the years of 2000, net banking was introduced. As we moved to 2006, mobile banking was introduced in the country, and now this is the time to capture the emerging technologies like artificial intelligence into the banking sector and thereby develop this sector substantially. However, there might be emerging challenges as far as data protection is considered due to this digitalization of technology, and the regulator has to take care of that challenges also. So, economic survey clearly stated about what might be the challenges and how the government of India should be prepared in order to challenge this emerging artificial intelligence challenges. This is another thing that they have focused on. So, the last aspect that they have discussed is how cyber security has to be enhanced in the country due to the so-called increasing cyber crimes that they have made in the next part of the so-called economic survey chapter 2. This is about the banking sector in India in brief, what was said by the economic survey, and I will be making another video for the same chapter where I will be discussing about the remaining component of chapter 2. So I have given the summary in my last class for the chapter 2. Now this is in detail analysis of banking sector as far as this is considered. So please allow me to share a screen so that it will be clear to you on what are the aspects that we have discussed so far, and that will be giving you a clear analysis on how the banking sector have been performing in India. So this is chapter 2, ladies and gentlemen. You can download it from my Telegram channel. The link is provided in the description box, which you find below this. So as far as the banks is considered, what are the major segments? I have highlighted the important components here. So this is second chapter, monetary and financial sector developments in the country. The cart and the horse. Cart is financial institutions, horse is Indian economy. Oh, sorry, economy is cart, horse is the one which is pulling it, that is financial institutions. So what they have discussed here, they have discussed about the banking sector. As I said, we are discussing about the banking sector here. So particularly if you go to the banking sector, look at this. Performance of Indian banking sector. There has been improvement in asset quality of the banks. The gross NPA ratios of scheduled commercial banks has declined consistently from its peak in financial year 18 to a 12-year low of 2.6% by the end of 2024. The lower GNPAs and higher provisionings also contributed for decline in net NPAs around 0.6% by September 2024, and that was also given in the graph. So 2.6% gross NPAs, net NPAs is 0.6%, and CRAR is somewhere around 16.7%. And the next thing is, as far as common equity tier is considered, almost all the banks in the country has achieved this CET1 requirements of 8%. That is another important thing in this survey. So the next one is profit after tax is 22.2%, and almost all the banks have shown consistent returns on equities and on their assets. As a result, the banking sector in the country was again in a very good position thanks to this return on assets as well as the so-called return on equities that they had. Most of the banks have achieved these two things. Next, trends in bank credit. If you look at how the bank's credit has been performing in the country, there has been double-digit growth here, and the bank credit has started converging towards deposit growth. Net growth rate in non-food credit has been increased substantially, and then non-banking financial companies in the country started giving the so-called more credit in the country. When you go for the sectoral-wise analysis of the bank credit, agriculture has attained a substantial amount, that is 5.1%, and in this industrial sector also got somewhere around 4.4%, and MSMEs has got huge amount of credit in all the credits that they have reached. Going further, if you look at the so-called the Monetary Policy Committee recommendations, so this is important, guys. On all the FCNR deposits, the interest rate ceiling has increased by RBI. So FCNR deposits are the foreign deposits that the people are making. If they are keeping for 1 to 3 years, they have kept a ceiling on the total amount of loans that they can, total amount of that interest rate that the banks can do. And for 3 to 5 years, they have increased this. So this is going to attract higher investments in the country. That is the next thing that they have given. Subsequently, if you look at the credit and GDP growth rate, there has been a positive credit and GDP growth rate in the country, and this has been the difference between GDP growth and the credit growth is slowly closing in the country. That is another observation according to RBI. Now when you go for cross-country comparisons, particularly to the total credit that non-financial sectors as a percent of GDP that they are getting, so the top country is China, which is giving, Chinese banks are giving too much loans to the so-called private sector compared to Malaysia and Japan. China, Malaysia, Japan are the three countries where the banks have been substantially providing loans to the private sector. When it comes to India, it is in the 8th position. Next, as far as rural financial institutions are considered, as I said, inclusive growth, regional rural banks, rural cooperative banks, scheduled commercial banks, small finance banks, NBFCs, microfinancial institutions, local area banks are all playing a very crucial role in ensuring that there are rural financial institutions spread. All are managed by NABARD. And if you go back to RRBs established in 1975 under RRBs Act of 1976, initially there were 5 banks in 1975. 133 banks were established by 2006. They were substantially brought down to 43 in the year 2023 by amalgamations to increase their performance. Right. Today, in almost 696 districts, you have RRBs operating with 21,856 branches. Almost 22,000 branches are there. And all the 43 RRBs were sponsored by 12 scheduled commercial banks. Almost 31.3 crore deposits were present in all this. I said 3.3 crores, that is around 31 crore deposits, and 3 crore loans were loan accounts were also opened. The government approved almost 10,000 rupees or 11,000 crore rupees as recapitalization assistance for these banks during the financial year 22 and 23. As a result, all this has helped for the consolidation of RRBs and higher level performance of RRBs in the country. This has also provided a way for reducing the gross NPAs of RRBs in the country from 7.3% to 6.5% by financial year 24. Speaking about the developmental financial institutions, they support the economic's progress by boosting a particular sector, particularly if you look at the developmental financial institutions between 1950s and 60s. You have Industrial Financial Corporation of India, ICICI, IDBI. All these are the things over a period of time they were converted to banks and non-banks. And in the year 1997, Infrastructure Development Financial Company, Indian Infrastructure Financial Company Limited was established. And in the year 2021, National Bank for Financing Infrastructure Development was established. So they have spoken about how IAFCL has helped in improving the banking credit to the private-public partnership projects. As a result, it is showing that how this has helped in improving the business in the country. 2.27 paragraph number 27 in this second chapter is important. It speaks about National Bank for Financing Infrastructure Development, which was established through NAB FID Act 2021. It is an all India financial intermediary. So the other financial intermediaries are SIDBI, NHB, Exim Bank, NABARD. So NAB FID is the 5th of all India financial intermediary. Here they will ask a question. Right. Now they will not ask about how this NAB FID is performing in the country. Next is use of artificial intelligence by the banks. If you look at how banking sector has started using technologies. In the year 1960, ATMs were introduced. 1970s, digital card or card payments have been introduced. 24/7 online banking sector was introduced at the global level in the banking sector of 2000. And then in 2010, by 2010, mobile banking started coming into operations. Now this is the age of artificial intelligence and machine learning, which has to be applied by the banks. And if banks are improving, then they can apply it for credit underwriting, regulatory capital planning, liquidity management, fraud detection, prevention, risk assessment and management. In almost all the sectors, where you can use this artificial intelligence and large learning models. However, the risks associated with this artificial intelligence is lack of transparency can lead to lack of accountability, and they may increase the risks in tracking and tracing the decisions. What are the risks? Human resources, inadequate human oversight can be a problem. Cyber risks, malicious usages, system-related risks such as inability to intervene on market correlations, and third-party dependencies may increase. So for that, what OECD has set some core principles to govern the use of artificial intelligence. Among them, we have one important policy framework known as Hiroshima Artificial Intelligence Policy Framework, Process Comprehensive Policy Framework, established in December 2023, and this is one of the significant things that is important for the country to develop global architecture for artificial intelligence. Substantially, if we move to the functioning of the so-called efficacy of insolvency laws, Insolvency and Bankruptcy Code, which was introduced in the year 2016, has played a substantial role in improving the so-called performing assets of the banks. So by September 2024, 1068 resolutions were passed. 3.6 lakh crore were substantially reclaimed by this Insolvency and Bankruptcy Code. This is what they have given. And Insolvency Bankruptcy Code has helped the system to regulate forex hedging by firms. So in order to hedge from risks, the firms started improving their currency, improving their capital, reducing the bond credit spread. So whatever the credit spread for bonds are reduced, so they started decreasing it, and then they went for exports promotion. As a result, even in those companies which are looking at export promotion, IBC was successful in getting the money back. So this is what IBC and National Companies Law Tribunal Act is. So they have given in a separate box about how this has performed normally. When IBC was introduced in the year 2016, the government of India asked IBC to solve the problems within 180 days with an extension of 90 days with the help of Committee of Creditors and Adjudicating Authorities. If these people are accepting it, who is the adjudicating authority under Insolvency and Bankruptcy Code? That is National Companies Law Tribunal. If you accept for this, then they can extend. However, over a period of time, what IBC has shown this is the amount of time that was given to the insolvency professional to solve these problems is not enough. As a result, they have substantially increased to 330 days timeline. So from 180 days extended to 90 days, further it was extended to 330 days. So on an average, it is taking somewhere around 582 days to solve the problems in the non-performing assets of through IBC code, and this was again a substantial progress that it contains. And here they spoken about what are the issues that IBC is facing, such as the admission of cases, and then normally it has to be admitted within 14 days and it has to be resolved within 180 days. This is one problem where they are taking the time. And the financial system digital credit information repositories and information utilities are also present under IBC. They are also working beautifully well according to this source. So in and all, this is about the banking sector that the economic survey has taken. As far as in and out, this is about the economic survey, particularly as far as banks are considered. So we have spoken about the financial health of the banks, regional rural banks, developmental financial institutions, and then we have spoken about insolvency and bankruptcy code and how they have functioned in recovery and use of artificial intelligence in the banking sector. These are the things that they have given. Those who want that document, you can download from my channel of Telegram. The description box was given below. So substantially, I will move to the capital markets and insurance and pensions tomorrow. Thanks for joining. Have a great day. Wish you all good luck.